The ECB's Pierre Wunsch says it is far too early to start considering a half-point rate cut in December. He tells Bloomberg we need more inflation data before deciding. Here in the UK, we are watching gilts closely as Chancellor Rachel Reeves says she will change the fiscal rules, potentially allowing her to borrow an extra £70 billion over the next 5 years. Plus, Mercedes running out of gas. The German car maker sees profitability fall well below target amid slumping Chinese demand. We bring you the details and the latest data on Europe's biggest economy. Let's check in on the European markets map then. You have the UK FTSE 100 just eking out some very modest gains. You can give a hat tip to Natwest on the back of that. A very strong performance in terms of the earnings from the banking space more generally across the UK, and certainly Natwest is part of that story with the earnings crossing and a beat coming through earlier in the session. On the downside, in terms of your sectors, the biggest losses coming through once again for the auto sector was Mercedes, and a big miss, as we said in the headlines, around the profit metrics. The DAX then down just 0.1%. The CAC Carron also off by 0.3. It's broadly a risk-off mood and also a market that seems to be looking for additional catalysts. Let's flip the board and look cross-asset then. The bond market sell-off that we saw in terms of treasuries pronounced at the front end of this week, that has eased. Again, you're back below 420 on the benchmark US 10-year at 418. Yields currently down 3 basis points. 108 on the single currency. The US dollar, by the way, is set for its fourth straight weekly gain. Currently 108 on the single currency. Weighing up the commentary from ECB officials, a debate going on as to whether or not they go 50 or 25 in December, and that debate is live. Japanese yen currently at 152. Elections on Sunday, and Brent currently off 0.1%. Here's the latest when it comes to the IFO German Business Confidence Index coming through and rising. For the month of October, the confidence index coming in at 86.5. That is above the estimates of 85.6. And of course, it follows the manufacturing and services PMI data out earlier this week that showed an improvement, at least modest improvement, on both of those factors when it comes to the German economy. You can see the move over 19 days, euro-dollar, in that space of time, down 2.8%. Here's the impact then across the German yields. 208 on the 2-year at the mid-end, front-end 2-year, of course, at the back end on the 10-year, 226. Not a lot of reaction so far across bonds on the back of this data. For the conversations that matter, the insights you need to know, let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in for Francine Lacqua here in London. And Mercedes shares are down this morning. One of the big corporate stories that we are focused on. That's after reporting, as I mentioned, disappointing third quarter earnings, profits squeezed. The automaker plans to step up cost reductions after fierce competition and weaker demand in China hit the luxury car makers' profits. Let's get the details and bring in Bloomberg's Oliver Crook, who has been detailing and going through the numbers for us. Join us out of Berlin. Ollie, break down the key metrics for us and where it leaves this car maker.
Yeah, listen, Tom, as you can see in the early session here, about 2.5% for Mercedes-Benz. And we knew this was going to be a tough quarter because we got that profit warning a couple of weeks ago from Mercedes-Benz where they said that basically their global sales would be down 3%, in large part due to China, where sales were down 13%, which is absolutely mammoth for them, their most important market. And of course, electric vehicle sales also down 31%. What we got today, Tom, was their margin. And this is absolutely key when we look at how profitable each of the car sells, particularly for Mercedes-Benz, because they've basically abandoned the volume game. They are just trying to sell high-margin cars, not the greatest number. So what we got was 4.7% margin. The estimates were for 8%, and last year it was at 12.4%. So, Tom, that is a major erosion for the Mercedes-Benz margins right now. And from what we saw from their outlook, it's not going to get any better in the fourth quarter.
Ollie, to what extent, the other side of the story, we look at Tesla, the blowout earnings report, the 22% increase in shares yesterday, adding $34 billion to Musk's wealth. To what extent is Tesla the canary in the coal mine when it comes to maybe green shoots for this auto sector, or is the story around Tesla idiosyncratic and not going to benefit these German automakers in the medium term?
Listen, Tom, when you look at the sort of outlook, I think that the Tesla story is much more idiosyncratic. And I've put together the comps about kind of what we've got from Tesla versus Mercedes-Benz. I mean, just look at this margin coming out from Tesla, 17%. That is absolutely huge, and it's much larger than what had been anticipated from analysts. Again, showing that to 4.7% for Mercedes-Benz. I also was looking at the volume of cars that they sold. I found this really interesting. Mercedes sold 500,000 cars last quarter. Tesla 460,000 cars. That is just about 50,000 cars difference. This is Mercedes, a car company that is 100 years old. So all of this putting into context. And again, the share move, $153 billion. That is how much was added to the Tesla market cap yesterday. That is more, Tom, than the combination of Stellantis, Volkswagen, BMW combined. So just telling you a little bit about how the investors are seeing this market in terms of their valuations.
That is quite the superlative, isn't it? Bloomberg's Oliver Crook breaking down the story around the auto market. Mercedes on the downside, Tesla on the upside is the simple take on that. Ollie, with the details, thank you very much indeed. So from Mercedes to the broader German economy then, and clearly the auto market and the stalling of that economic engine is a key challenge for that economy. Let's bring in the president of the IFO Institute, Clemens Fuest, on the latest details that come through. Clemens, we have an increase in terms of the business sentiment. Business sentiment is improving at the margins in Germany. Your take on what you're seeing and whether or not you think this is going to be sustainable?
Well, that's the big issue. It's an improvement after 4 declines. That's a good sign. It's coming strongly from expectations. So, for instance, in manufacturing, companies tell us the current situation has worsened, but they expect an improvement in the months to come. We get a positive reading from services, where companies, in particular in tourism, in IT, in logistics, are telling us things are improving. But of course, after 4 declines, this is a positive sign. But whether it's a turnaround, we don't know yet.
Clemens, so maybe we've bottomed out then. And if we look at the PMI data of yesterday for Germany, clearly there was a bit of a turnaround there to the upside. So whether or not we're starting to see very obvious green shoots, when you talk to those members or you talk to those participants in the survey and they tell you they see an improvement, are they giving you details on what is driving that improvement?
Well, we asked them about particular aspects of their situation, and manufacturing companies are telling us that they are still lacking orders and the order book is not improving. And in a way, this is in contrast to the improvement in expectations. At the same time, we have to see that the current situation is assessed as very bad, and the expectations indicator tells us something about starting from where we are, how is this continuing. So if the situation is very bad, it's kind of natural in this number that expectations at some point will improve. The question is, how sustainable is this? And I guess there, with all the uncertainty ahead, it's too early to say this is a turnaround.
And we had a reminder today, of course, and we were just talking about that with Oliver Crook, around the auto sector of Germany, Mercedes, and the miss in terms of the earnings there and the outlook as well being challenged. Do you expect that the car-making segment of that economy, the automakers of Germany, is that going to continue to be a headwind for this economy in 2025?
I'm afraid it is. Our reading today from the car sector is negative. So the positive readings are coming from other sectors, the chemical industry, for instance. But the car sector continues to have challenges, to face challenges. It is a fact that German companies are facing headwinds in this transition to electric mobility, as a lot of uncertainty about this is playing out. Currently, the companies that have problems are those, maybe paradoxically, producing more electric cars or having moved more consequentially towards electric cars, because electric car sales in Europe are down. Of course, in China, there are particular issues. And the combination means, we do have strong headwinds for this industry, and I would expect this to continue. So economic growth, a recovery, will need to come from other sectors.
More broadly, is German manufacturing starting to see the impacts of Chinese stimulus?
German manufacturing will probably benefit from a Chinese stimulus, but structurally, there are strong headwinds for German manufacturing. We have the automotive sector. This is 16% of value added in German manufacturing, and we have headwinds there. We have higher energy prices, and we have the prospect of a more protectionist world, and that will have an impact. So this is really a challenging environment for German manufacturing. And for Germany as a whole, probably growth will have to come more from other sectors, including services.
There's a debate within the halls of the ECB now about whether they go 50 basis points or 25 in December. Clemens, your understanding, do you think Germany at least needs a bigger rate cut from this central bank?
I think for Germany, a bigger rate cut would be appropriate. For the Eurozone as a whole, which is the focus of the ECB, I think that's not quite the case. So Germany is a laggard in the recovery in the Eurozone. So for Germany, rate cuts would be appropriate. As I said, for the Eurozone as a whole, I'm not sure. We do have price pressures in services, and I think the ECB needs to watch that, because it would be bad if this inflation dynamic we are seeing currently, so declining inflation rate, if that turned around and the ECB was caught on the wrong foot. So for Germany, yes, more rate cuts would be appropriate. For the Eurozone, less so.
OK, very interesting. Meanwhile, we have the Chancellor, Olaf Scholz, in India, and there's some moves being made in terms of what's happening in the Bundestag around trying to make it easier to attract skilled talent from India to help fill the gaps in the labour market there, or at least a tight labour market. What is the extent of the shortage of labour right now in Germany?
There is currently a significant shortage of labor in, I would say, parts of the economy. At the same time, the slowing economy lets some firms maybe not lay off people, but not replace their workforce. But in some sectors of the economy, especially the growing sectors like health, we do have a shortage. And looking ahead in the years ahead, due to our demographic structure with the baby boomers retiring, this will get worse. I think that's why it's very important to invest in relationships, in ways of bringing more people to Germany, not immediately, but in the years to come, when this labor shortage will become a lot worse.
Always fantastic context on these issues. IFO Institute President Clemens Fuest, thank you very much indeed. As the survey comes in, the outlook improves for Germany. The IFO Business Confidence Survey coming in, ticking slightly higher. But again, Clemens Fuest giving us the context, and the need for further rate cuts, certainly for the German economy, is the view there. Coming up, Natwest, the biggest gainer this morning on the FTSE 100. As the UK bank releases its quarterly results, we have the details. This is Bloomberg.
We haven't made a major acquisition because we don't need it. We are growing profitably. As of June, we were growing our top line at 10%. We have grown 60 million customers in the last 10 years. But very important, we're growing profitably. And we're rolling out our global platforms now in retail and consumer with our own tech stack. And so we're able to compete, with our current size.
At the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
UBS CEO Sergio Motti there, warning of a cost to the economy if bank mergers are blocked. And Santander's Anna Botín saying the company has no need to make a major acquisition at present. Let's get more on the European bank space and focus in on Natwest, the top performer right now across the FTSE 100, gaining after raising its outlook for the year and topping estimates in terms of the earnings in the third quarter. Bloomberg's William Shaw has been going through all the numbers for us. Will, how has Natwest performed today then?
Really well. They'll be really pleased. Paul Thwaite, the boss, hasn't been in place for a huge amount of time. I'm sure he'll be very happy with these results. The share price has reached a 9-year high this morning. They've raised their outlook for the year end. Return on tangible equity, they now expect 15%. That was 14% beforehand. They've also bumped up the revenue outlook to over 14 billion pounds for the year. Net interest margin, a key indicator of profitability, is also doing better than the previous quarter. So they will be very pleased. Their investors are pleased. I was on the media call a little while ago. They were talking about there being deposit growth and strong mortgage growth since Q1 this year. The economic situation is looking a little better. Waiting for interest rates to come down. It seems like the outlook broadly is improving, and I think that's something that applies to UK banks more generally.
Yeah, well, on that note then, so really strong numbers coming through from Natwest, and clearly investors are rewarding the executive team for that, at least for the moment. How do those numbers at Natwest compare, to your point, with their peers in this sector?
So Barclays has been doing very well as well. They reported better than expected income from their two biggest businesses. That's kind of an indication that the CEO's cost-cutting plans aiming at boosting revenue are beginning to pay off. And again, like with NatWest, we saw their share price touch the highest in 9 years again earlier this week. Then Lloyds Bank also doing very well. They beat expectations earlier in the week. As it turned out that borrowers were coping better than expected with their payments. So it's kind of like a broad UK phenomenon, really.
OK, Bloomberg's Will Shaw on these UK banks. A solid week in terms of the earnings front, and certainly investors getting on board with a gain of almost 5% for NatWest so far in the session. Will Shaw, thank you very much indeed for the context. Now, SpaceX's Dragon spacecraft has returned to Earth. You're looking at live pictures right now. After its 7-month mission, it splashed down off the Florida coast early on Friday morning and returned a crew of Russian and American astronauts. They were due to return 2 months ago, but their homecoming was delayed due to problems with Boeing's new Starliner astronaut capsule. It is the longest mission that Crew Dragon has performed. They haven't experienced gravity in 232 days, and that's why they are struggling to stand. As you can see, we were seeing pictures of them being taken out of the capsule that splashed down, a little over an hour ago. Coming up, renewed optimism for the Mag 7 after a lacklustre quarter. We're going to look ahead to what will be a huge big tech earnings week next week. The preview coming up. This is Bloomberg.
Does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much, just close your eyes and buy, probably Mag 7.
I think it's a key part of a portfolio, but what we're seeing, and I think it's slightly more exciting, is a broadening of the performance of the S&P rather than just a narrow concentration.
It's been actually a pretty broad bull market. When you look at it from where it started to where we are now, there's a lot of, just about everything's up at least 20%. But I think we're looking at 6,300 next year, and by the end of the decade, I think a conservative target is actually 8,000. So I think we got a decade where we have a bull market.
OK, there we go, 8,000 on the S&P. Not too much of a stretch. That's the view from Ed Yardina, at least. So, Mag 7 stocks, a number of them reporting next week. Really, really big week in terms of the earnings numbers coming through from the key technology names. On Tuesday, you're going to have AMD and Alphabet. AMD, to what extent are they catching up with NVIDIA in terms of those AI accelerators? NVIDIA has that 90% share or thereabouts of the market. To what extent is AMD making progress? We've seen evidence that they are starting to play catch-up. They've got a long way to go, but details on Tuesday will be really interesting on that front. Alphabet and Microsoft and Meta and Amazon, it's all going to be about what those hyperscalers are doing in terms of the spend on those GPUs, on those AI accelerators, on those data centers. Are they going to keep that spend going? And are they seeing more evidence of the return on investment from all that CapEx they're spending on the hardware that is powering this AI revolution? That's going to be key for all of those key companies. on Intel on Thursday, by the way. Really fascinating, of course. It faces its own challenges, Intel, so we'll see to what extent they are having any success at all in rewriting that business. Tesla, let's not forget, pre-market, you could see a bit of a drop there, but that's after a gain of almost 22% yesterday in the share price. That is the biggest jump in about 11 years, added about $34 billion to the wealth of Elon Musk. Talking of Elon Musk, he has reportedly been in regular contact with Russian President Vladimir Putin since late 2022. That is according to the Wall Street Journal. Former officials from the US, Europe and Russia said the pair discussed business, geopolitical tensions and personal topics. The report raises sensitivities given Musk's ties with the US military and intelligence agencies. Plenty more coming up. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The ECB's Pierre Wunsch said it is far too early to start considering a half-point rate cut in December. He tells Bloomberg more inflation data is needed before deciding. Here in the UK, watching gilts closely as Chancellor Rachel Reeves says she will change the fiscal rules, potentially allowing her to borrow an extra £70 billion over the next 5 years. Plus, Mercedes running out of gas. The German carmaker sees profitability fall well below target amid slumping Chinese demand. Now, ECB Governing Council member Joachim Nagel says the central bank should not hurry too much to lower borrowing costs but remain flexible. The Bundesbank president told us all options are on the table for the December meeting.
We shouldn't be too hasty. We should be cautious, keep our track to really look what data is coming in. We have in December, when our next meeting is coming, we have our new projection. The new projection will include the year 2027. And then we have maybe more guidance, more orientation. But I'm not in favor to speculate too much what is necessary in our December meeting. This is definitely, I believe, not helpful.
Well, the hawks are certainly coming out to voice their views. We had the European Central Bank Governing Council member Gedimas Simkas as well of Lithuania saying there is nothing that justifies a half-point move in December, at least not now. Let's bring in Bloomberg's Valerie Teitel then for the wrap of all of this and how the market should be interpreting it. Val, we know that ECB members are debating. We've been hearing from the hawks pushing back on that 50 basis point expectation that some on the dovish side have been pushing for. How should the markets be calibrating all of this?
Yeah, look, we heard from Nagel there saying he doesn't want to speculate on a 50 basis point cut. But I have to say, Tom, the market is very much speculating that one of the next two moves from the ECB will be a jumbo cut of 50 basis points. I've got a chart here which just shows how the pricing has escalated. This red line here showing the pricing going past 50 basis points for the next two meetings. We're now pricing in just under 70 basis points worth of cuts if you combine December and January. Now, we have had some ECB members throw a bit of cold water on that speculation. We also heard from Pierre Wunsch on the side of the IMF yesterday.
Colleagues are already discussing cutting 50 basis points in December. We'll have two more readings of inflation before we have new projections. My take on it is, of course, the European economy is weaker than we thought, and we had an inflation surprise on the downside in September. But I think, honestly, talking about a 50 basis point cut in December is premature.
Saying it's just a bit too premature and the market is jumping to conclusions a bit more quickly. But over the last month, we have seen this weakness in the euro as the market prices in more expectations of cuts from the ECB. Down nearly 3% on the month, Tom. Now, a lot of that has been driven by dollar strength in the back of the U.S. election and speculation about a Trump win. There has been a lot of action in the vol market when it comes to this FX pair. If you change on to my next graphic, I found this very surprising. We've seen a big jump in 2-week option implied volatility. Now that the next 2 weeks does encapsulate the potential result of the U.S. election, we've seen this big spike. It's one of the biggest of the currency pair. It's the 8th biggest, Tom, since the European sovereign debt crisis. So just to put that into a bit of perspective for you, we've also heard from the likes of Goldman saying they see a 10% decline in euro dollar if Trump does get into the office and he follows through with those harsh tariffs on Europe and China.
OK, Bloomberg's Radio Total. Thank you very much indeed. We'll quickly check in on German bonds. You're seeing a little bit of a sell-off right now at the front end, so yields up 2 basis points. It seems that some of this could be down to that improvement in the IFO business sentiment gauge that came out at the top of the hour, but also those hawkish comments that Valerie was referencing there, particularly, of course, the Lithuanian ECB governor, Simkus, suggesting that he isn't ready, at least now, to push for a jumbo cut in December. He doesn't see the conditions there for that and echoes a number of the hawks, of course, in terms of that pushback. So you're seeing a bit of selling pressure, yields up at the front end on the German 2-year at 2.10. Joining us for a wider markets deep dive is Freya Beamish, Chief Economist at TS Lombard. Freya, maybe we just start there with the ECB. Do you think they go 50 or the markets are kind of getting over their skis on that front?
I don't see why they're waiting at this stage in the game. I think there's a great proclivity to. I understand why, because there's a great proclivity in the ECB to kind of look in the rearview mirror and look at the wage data. And of course, that has taken longer to come down. But if you compare the European outturn with the US outturn, the US has allowed demand to help supply to repair. And that's where the productivity growth is starting to really break out above previous trends in the US. The same cannot be said in Europe because the ECB has been so worried about structural deterioration that they've tried to crush demand back down to supply. And as a result, there's been no room for productivity growth to really pick up. So what that means is, yes, hopefully they'll get on and cut rates quite quickly. But actually, where there's perhaps markets getting a little bit over their skis is the economy should start to respond well in Europe once policymakers get out of the way. Because I think less of the structural deterioration is actually about just the energy shock, which is clearly a problem. And the kind of the changed relationship with China. Some of it, at least, is just because the ECB has had policy too tight.
OK, so that getting out of the way, what does that look like, Freya? Is that kind of sub 3% on the main refinancing rate for ECB in the first half of next year? Where do you see rates longer term for the ECB?
I see them moving rates down relatively rapidly, but then markets are probably a little bit ahead of themselves in terms of how much they're pricing in for terminal rates.
OK, interesting. To the UK then, Freya, and I know you have views on this. So the news coming through, Rachel Reeves, she will be adjusting that fiscal rule. We're going to get the details, of course, next week with the budget. We did see a bit of a reaction in the gilt markets earlier this week, bit of a sell-off. Is that kind of a knee-jerk reaction, or does it suggest that she does risk provoking the bond vigilantes?
Yeah, I think all of this bond vigilante stuff is knee-jerk reaction. There's very little evidence over long time periods of there being sort of a one-for-one mapping between bond issuance and yields. They're just, if you plot those two things on a chart, you're going to get a horrible splodge that tells you absolutely nothing. I think where there's more evidence for a relationship between the fiscal side of things and yields and the broader nature of inflation is in the type of inflation that is hitting the economy and the degree of uncertainty. So when we look back to data going back to sort of the 60s and 70s, what we see is that there are different regimes for the bond market. And when there's high and volatile inflation that tends to be driven by negative supply shocks, that's when investors, when that's proved to be persistent, that's when investors really start to get in and price in higher term premia. So what the Chancellor's doing by releasing herself from the kind of the burdensome aspects of this fiscal rule, that might be taken by the bond vigilantes as worrying, but actually it's just there to improve the supply side of the UK economy, which should bring down the risk of that type of supply side driven inflation. She wants to be able to give herself space to do investment in the UK economy, which is sorely needed. So that should actually be something that is better for term premium, not driving term premium up.
Freya, how much kind of weight would you put in a scenario that unfolds after the budget next week, where we have a bit more fiscal support for this economy, but a Bank of England that is progressing cautiously, at least more cautiously than maybe some of its peers, and maybe that's good news for the pound?
Yep, I think a combination of kind of not entirely pro-cyclical fiscal policy, but sort of looser fiscal policy and tight monetary policy tends to be good for the currency. I think the Bank of England, again, I think there's a tendency to sort of look in the rearview mirror to worry that there's been a sort of supply side deterioration, and actually there isn't so much a need to sort of try to crush demand back down to supply, and actually supply would be recovering a lot more positively at this stage in the game if demand was allowed to provide that little bit of overheating, and that productivity growth would actually respond to that. So that's, again, a sort of an argument that the Bank of England perhaps should be cutting rates a little bit more rapidly and a little bit less kind of trepidatiously, but the terminal rate probably has risen in the UK as well.
Freya, on China, another area of expertise for you. You've written a note that talks about these 180-degree turns that we've seen from Chinese officials, whether it's on local government debt or on housing or some kind of support for the consumer. When do you think we will start to feel the benefits of that, if at all, particularly in the European economy?
Yeah, great question. I mean, the way I kind of, the metaphor that I'm using is that they have been digging a hole, a very deflationary hole for both China and for the rest of the world and those economies that are particularly related, that are particularly exposed to China, such as Germany. They've been digging this massive kind of deflationary hole, and about a month ago they realized that probably wasn't such a great idea, that they're already facing a kind of a deleveraging drag on demand over a long period of time. So trying to support the economy purely by focusing on expanding supply was always going to just exacerbate that deflationary downtrend. So what we see in the mix of the reports that are coming out over the past kind of months or so, and the actual announcements, is that they do seem to be recognizing that kind of China 2.0, where you're just relying on external demand, is not going to work from the perspective of the rest of the world. China's too big and the rest of the world is already wise to it. And it's probably not going to work from the perspective of China either, because it decreases returns, which is the key deficiency of income in the household sector in China. And it's now starting to impact on constraining wage growth as well. It looks like wage growth is at the kind of the COVID lows and kind of standard deviations below the pre-COVID rates. And that's a breach of the social contract in China. So there has to be a pivot there in China. We're starting to see that in a marginal sense.
OK, Freya Beamish, really smart analysis, as always, Chief Economist at TS Lombard. Thank you very much indeed for providing the context around some of these key market themes. Coming up, talking of the UK Chancellor, Rachel Reeves, she says she will change the government's fiscal rules, as we've been discussing there with Freya. We're going to bring you more details on that and how it positions the Chancellor ahead of a major week for her and this Labour government. Stay with us. This is Bloomberg. Welcome back. You are watching The Pulse. Happy Friday, everyone. We are showing you live pictures of German Chancellor Scholz alongside Indian Prime Minister Modi in New Delhi. They are meeting, as you can see. Also talking about, interestingly, one of the topics is whether or not Germany can get more skilled immigration from India to meet a shortage in labour. So we'll keep across that story for you, of course. A major meeting between two very significant players on the global stage. Now to the UK. We're going to be discussing in a moment England's wealth cap with Bloomberg's Tiffany Choi. But first, let's look ahead to that crucial UK budget next week. Going to be a major event for us and, of course, many of those invested in the UK. Chancellor Rachel Reeves says she will change the country's fiscal rules. She's going to go there. She's going to boost government investment. That is the idea. It's a move that could allow Britain to borrow as much as £70 billion more, at least over the next 5 years. Let's bring in Morwenna Economian for the details on this from Bloomberg Markets Today. Morwenna, what should we understand in terms of this change in the fiscal rule? Are the markets going to accept it? How much scope is it going to give the Chancellor to invest and spend on capex?
Well, as you say, there is potential for another £70 billion of borrowing as a result of changing the fiscal rules. Essentially, what she's proposing is for measures which take into account the assets and investment that are on the government's balance sheet, as well as the debt. So effectively cancelling some of it out and therefore allowing more borrowing. Now, this, the scope and how the market will actually respond to it, we saw a glimmer of that yesterday. We did see bond yields rising, and the gap between, say, the UK 10-year bond and the German one extending to its biggest since last year. And that does suggest that there's a little bit of nervousness there about borrowing more, could make borrowing a little bit more expensive. We all remember what happened with the mini budget a couple of years ago. Nothing quite so that extreme, but it could make borrowing a little bit more expensive. And of course, that would also limit the Bank of England's scope potentially to reduce interest rates. We saw a little bit of market pricing that in yesterday as well, which in turn makes those gilt yields go up a little bit higher. So it's not quite clear how, obviously, the market would respond to it in eventuality, but certainly there's a bit of uncertainty there. More borrowing obviously does make a difference.
Yeah, it's interesting. Freya Beamish just telling us from TS Lombard she doesn't think there's going to be anything more than a knee-jerk reaction in the gilt markets, and that longer term this shouldn't be too much of an issue. They can absorb this debt, but we'll see. As you say, it's going to be certainly a focal point, isn't it, how the gilt markets react to that budget. Talking of the budget, the Prime Minister Keir Starmer, I've had a number of emails into my inbox about this, heads in hands. A lot of anger, actually, I think. The way he characterised people who have stock holdings and shareholdings, describing them as not working people, because, of course, he's characterised those people. Then you're not going to raise taxes on hard-working people, but if you own shares and stocks, well, maybe you're in our sights. What is this all? This is about capital gains tax. Has he set himself up for a fall here? How's the investor community reacting to this?
It's certainly a very tricky line, and already our political reporter Alan Milligan has said his spokesperson has already tried to give a little bit of clarity on what he meant.
Walking it back, no?
Essentially, yes, and saying, you know, really he meant the people who get most of their income from shares and assets rather than just people who have a little bit, because as a lot of the emails I've been getting today as well are pointing out, a lot of people have some shares, they have savings. He's talking about savings as well. And that's what people are encouraged to do. And you don't have to be an investment banker to have, you know, some assets of your own. And it's seen as being a bit of an old-fashioned definition of working people, this sort of, looking back to the sort of...
We thought Corbyn had been banished to the sidelines, but for some this will be Corbyn-esque in terms of the comment. But yes, they're rewording the phrasing, aren't they, around this?
Yeah, it definitely is seen as being something which perhaps wasn't intended to be as narrow in scope as it would suggest, and I think there's certainly going to be a little bit more clarity sourced, and I don't think this is going away anytime soon. OK, Moena, fantastic stuff. It's going to be very busy for you and the team next week, of course. Thank you for the context as we lead up to that budget then. Moena Koniam from the Markets Live team. You can get all the analysis, of course, on the website and on the terminal from Moena and the team. We're going to hear more from the UK Chancellor, of course, next week in that autumn budget special, airing live on Bloomberg TV, in EMEA and online on Wednesday, 12:30 p.m. London time. Now, talking of the UK and its prospects, the English town of Cambridge has been billed by some as the next Silicon Valley due to its fast-growing tech and life sciences industry. Bloomberg's Tiffany Choi joins us more for what is happening in Cambridge and how Cambridge could be emblematic of the opportunities, but maybe also the challenges for a UK that's trying to become a tech superpower. Talk to us about what you found then, Tiffany.
Yeah, so obviously a lot of British politicians have started paying attention to Cambridge as kind of maybe an engine to revive the ailing growth that we're seeing here in the UK overall. But I think a lot of residents in Cambridge have been like, wait a second, maybe we shouldn't be so quick to kind of compare ourselves to Silicon Valley, not least because the two places are very, very different, but also because not so differently is that both of the places are very, very unequal, and in Cambridge it's only getting worse. You know, you have a city with a hugely growing population, but the infrastructure and the average salary is just not growing to meet that growth. So in the last 10 years, housing prices went up by 78%, and average pay by 23%. And on many other metrics, Cambridge just has some of the worst inequality in the UK. Educational attainment inequality is some of the worst in the UK. The gap between the highest earners and lowest earners, some of the highest in the UK. And so, you know, you're really seeing a city that's kind of faced with these core problems of, you know, homelessness, water scarcity, a lack of transport.
Water scarcity as well. So what is the government doing to address some of these issues?
So there's been a bit of a lull period recently because of the change of government over the summer, but there are signs that, you know, especially with Labour's commitment to revive growth and get Britain building, that they are going to be committed to the cause. The Minister for Housing and Planning recently wrote a letter saying he was going to meet with local leaders and hold meetings and you know, pledge his commitment. But, you know, it's going to be a long road ahead. It's going to take a lot of money and a lot of time. And in our budget-constrained times, it's yet to be clear where we're going to see that money. But, you know, it's in everyone's interest. It's not just about inclusive growth. It's also about, you know, making sure that the ambitions themselves can be fulfilled, because if you don't have the office space or the lab space or the ways for people to commute to those spaces and homes for these people, then, you know, Cambridge just isn't really going to be a hub of any kind.
OK, Tiffany Choi, really great reporting. Thank you very much indeed. If Cambridge can't do it, how can the rest of the UK? I guess it's a litmus test, really, for the ambitions of this country. Coming up, we're going to hear what Geeta Gopinath, IMF First Director, Deputy Manager, has to say on the global economy. And more on that bump again in Tesla shares, up 22% in a single session yesterday. Stay with us. This is Bloomberg.
The US economy is one of the strongest among the major economies, if you look at those. And when we compare the US to the other G20 economies, it's the only economy whose GDP is higher now than we had projected before the pandemic. The only major economy. So it's a very strong economy, a lot of confidence in it.
IMF First Deputy Managing Director Geeta Gopinath. She didn't say there, but we're talking about US exceptionalism, of course. And talking of US exceptionalism, I'll get it out, it's a Friday. You look at the woes of the German automakers and then you compare that with Tesla. Smashed it on the third quarter earnings. The stock rallied 22% in a single session yesterday. That's the biggest pop that we've seen in more than 11 years, adding $153 billion in a single day to the market cap of that company. You can add up 3 or 4 German automakers to the mix to try and make up a market cap of that size. Also adding, by the way, about $34 billion to the wealth of Elon Musk. Let's see how that trades today, if there'll be any profit taking. Pre-market down 2.3%, but after the rally of yesterday, not really much of a move in the context. Now, in terms of what could propel US equities in the quarters ahead, look at this. The money markets adding $500 billion stateside. Just this year alone, it has hit a record $6.5 trillion of money or cash invested in money markets. The yield is still there. Even as you get that Fed cut, you'll certainly get more of a yield than you would if you parked it in a deposit in a US bank. But is that dry powder that can be used to put to work in the US stock markets, as Ed Yardeni points to 8,000 for the S&P? Just worth bearing in mind. Bloomberg recently launched, by the way, the weekend edition, going deeper into the context of some of these stories that shape markets and the world. You can scan the QR code on the screen to subscribe to the newsletter. Do that now. It contains essays, reviews and other stories that take an expansive view of finance, the economy, life and culture. Everything, essentially. Up next, Bloomberg's Brief with Danny Berger. Manus Cranny standing by. The Dream Team in New York. Stay with us. US futures, just marking for you, currently up on the S&P by 0.1%. Nasdaq futures pointing higher by just shy of 0.2%. Danny Berger, Manus Cranny will set you up for your Friday trading day stateside. This is Bloomberg.